What if I told you that money isn't just about numbers or strategies, but about psychology? The way you think, feel, and behave with money can determine your financial future more than anything else. Let's dive into The Psychology of Money by Morgan Housel and discover how mastering your mindset can lead to financial success. Chapter 1. No one's crazy. When it comes to money, it's easy to look at someone else's financial choices and think they're being irrational. Why would they buy that? Why aren't they investing in this? How can they be so reckless? But here's the thing. No one is actually crazy when it comes to money. It's all about perspective. And Morgan Housel is quick to remind us that financial decisions are deeply personal, shaped by our unique experiences, environments, and the way we've been taught to think about money. Imagine two people sitting down for a conversation about their financial habits. One grew up during a time of economic abundance, while the other experienced a severe financial crisis during their formative years. They're likely to have very different outlooks on saving, spending, and risk. To the person who experienced a financial downturn, saving aggressively might seem like the only smart choice. Meanwhile, the other person, having grown up with financial stability, might view investing in the stock market as the obvious way to grow wealth. Neither of them is wrong. They're just coming from different places. And that's the key takeaway of this chapter. Your history with money is what influences your present-day decisions. Let's take a closer look at this idea. Think about the people who lived through the Great Depression in the 1930s. For them, financial security wasn't just a goal, it was a necessity for survival. The scarcity mindset they developed influenced their behavior for the rest of their lives. Even when the economy eventually recovered, many people from that generation continued to save excessively and avoid financial risk. They couldn't shake the fear that another crisis could be around the corner. To someone who hadn't lived through that period, this behavior might seem overly cautious or even irrational. But for those who experienced the hardship firsthand, it made perfect sense. It was their way of protecting themselves from future uncertainty. Now, contrast this with someone who came of age during the economic boom of the 1980s or 1990s. For them, the stock market was a place of opportunity. They saw people getting rich through investments and believed that taking risks could lead to enormous rewards. The idea of leaving money in a savings account might have seemed like a waste, especially when they could be growing their wealth through high-risk, high-reward investments. Again, this behavior isn't irrational. It's shaped by the economic environment they grew up in. What Housel is trying to tell us is that financial behavior is far from universal. The decisions we make with money aren't just about the numbers. They're about our emotions, our upbringing, and the stories we tell ourselves about money. If you grew up in a household where money was always tight, you might feel anxious about spending, even if you're financially comfortable now. On the other hand, if you grew up in a home where money was never an issue, you might have a more relaxed attitude toward financial risk. Neither approach is inherently right or wrong, it's just different. Housel uses this idea to introduce the concept of empathy in financial discussions. When we judge others' financial choices without understanding their background, we're missing a crucial part of the story. It's easy to look at someone who spends lavishly and assume they're irresponsible, or to see someone who saves every penny and think they're being paranoid. But the truth is, we don't know what shaped their behavior. Financial decisions are rarely made in a vacuum. They're the result of years of experiences and influences, many of which are invisible to the outside world. To illustrate this point, Housel gives us the example of people who live in poverty versus those who are financially well off. For someone struggling to make ends meet, the idea of saving for the future might feel impossible. They're focused on survival, paying rent, buying food, and making sure their basic needs are met. Saving money or investing in the stock market is a luxury they can't afford. Meanwhile, someone with financial security might see saving as an obvious priority. They have the cushion to think about the future because their present needs are already taken care of. Again, neither person is crazy. They're just reacting to their circumstances. What's interesting is that these early experiences with money can have long-lasting effects. Housel points out that even as circumstances change, people often cling to the financial habits they developed in their youth. Someone who grew up poor might continue to live frugally even after they've achieved financial success. It's not because they need to. It's because that's how they've learned to navigate the world. Similarly, someone who grew up in abundance might continue to take risks with their money, even if those risks no longer make sense for their current situation. This idea ties into a broader concept. Financial decisions aren't just about the numbers, they're about our psychology. Housel argues that while we like to think we're making rational choices with our money, we're often driven by emotions like fear, greed, and insecurity. And these emotions are shaped by our personal histories. It's not enough to know the right financial strategies. We also need to understand the psychological forces that influence our behavior. One of the most striking examples of this is the fear of missing out, FOMO, that drives so many financial decisions. Picture this. The stock market is booming, and everyone around you is talking about the money they're making. It's hard not to get swept up in the excitement. Even if you know that investing at the top of the market is risky, the fear of being left behind can push you to make decisions that aren't in your best interest. This is a perfect example of how emotions can override logic when it comes to money. You know that the market will eventually correct itself, but the thrill of making quick gains, or the fear of missing out on those gains, can cloud your judgment. At the same time, fear can also drive us to be overly cautious. After a market crash or a personal financial setback, it's natural to feel hesitant about taking risks. But this fear can lead us to make overly conservative choices, like keeping all our money in a savings account or avoiding investments altogether. While this might feel safe in the short term, it can actually hinder long-term financial growth. Once again, our personal experiences and emotions are shaping our decisions in ways we might not even realize. Housel wants us to understand that everyone's financial journey is different, and we shouldn't be so quick to judge others, or even ourselves, when it comes to money. Instead, he encourages us to approach financial decisions with empathy and self-awareness. By recognizing that our financial behavior is influenced by our unique history, we can make more informed and thoughtful choices. The bottom line of this chapter is simple but profound. There's no one-size-fits-all approach to money. What works for one person might not work for another, and that's okay. The important thing is to understand where your own financial habits come from and to be open to the idea that they might not always serve you in the best way. By becoming more aware of the psychological forces at play, you can begin to make decisions that are truly in line with your goals and values, rather than simply reacting to the emotions and experiences of your past. In essence, the psychology of money begins by inviting us to look at money not just as a tool, but as a reflection of our own personal histories. No one's crazy when it comes to money, because every decision we make is based on a lifetime of experiences, emotions, and stories that are unique to us. Chapter 2. Luck and Risk. In Chapter 2 of The Psychology of Money, Morgan Housel introduces us to an idea that often gets overlooked in discussions about wealth: the roles of luck and risk. When we look at someone's financial success, it's easy to credit their intelligence, hard work, or good decisions. But the truth, Housel argues, is that luck plays a far larger role in success than we often acknowledge, just as risk plays a bigger role in failure than we care to admit. To illustrate this, Housel begins with a famous example: Bill Gates. We all know the story of Gates' success, the co-founder of Microsoft, a billionaire, and one of the most influential people in modern technology. But what we often forget is the stroke of luck that put him on that path. Gates was one of the few teenagers in the world who had access to a computer in the early 1970s. At a time when most people had never even seen a computer, Gates was spending hours programming, learning, and experimenting. That access gave him a head start that few others could match. Sure, he was incredibly talented and driven, but without that lucky break, his path to success might have looked very different. Housel uses this story to point out that while Gates' success was due in part to his hard work, intelligence, and skill, luck also played a crucial role. Timing, access, and circumstance all aligned perfectly for him, giving him the opportunity to become the person we know today. It's easy to look at Gates and say, if I just work as hard as him, I can be as successful. But that ignores the randomness and serendipity involved in his story. On the flip side, Housel reminds us that risk is always present too. He tells the story of Kent Evans, one of Gates' closest friends in high school. Evans was just as talented and ambitious as Gates, and the two of them were poised to take the tech world by storm. But Evans never got the chance. He tragically died in a mountaineering accident as a teenager. His story could have been just as successful as Gates', but risk intervened in a way that no one could have predicted. The contrast between Gates and Evans is a stark reminder that luck and risk are two sides of the same coin. We celebrate the successes and analyze them in detail, looking for patterns or strategies to replicate. But we rarely give the same attention to failures, especially when those failures are due to factors outside a person's control. Risk, like luck, is often invisible. And just as luck can propel someone to success, risk can derail even the most promising careers or plans. Housel urges us to think more deeply about how we view success and failure. It's tempting to see successful people as inherently smarter or more capable than others, but that perspective ignores the randomness of life. Conversely, when people fail, we often blame them for their poor decisions without considering the risks they faced, many of which may have been beyond their control. This understanding of luck and risk leads to an important lesson: humility. It's easy to fall into the trap of thinking that we've succeeded purely because of our own efforts, or that others have failed solely because of their mistakes. But life is much more complex than that. By acknowledging the role that luck plays in our own success, we can remain humble. And by recognizing the risks that others face, we can be more empathetic and understanding when things don't go as planned. Another critical point Housel makes is that financial success is often more about avoiding catastrophic mistakes than making brilliant moves. He compares it to surviving a game of Russian roulette. If you play long enough, even if you've been lucky so far, eventually, the odds will catch up with you. In finance, taking excessive risks may lead to big rewards in the short term, but eventually, those risks can catch up with you and wipe out years of progress. In this way, avoiding financial disaster is often more important than achieving extraordinary success. Housel also highlights the importance of understanding that your personal success or failure doesn't exist in isolation. In the broader financial world, success often depends on factors like economic cycles, market trends, and even geopolitical events, things that are largely beyond your control. For instance, an entrepreneur who launches a startup during a booming economy might experience rapid growth and success, while someone with an equally good idea who starts their business during a recession could struggle to stay afloat. The difference isn't necessarily in their talent or the quality of their ideas. It's in the timing and external conditions, things that are out of their hands. This realization can be both comforting and humbling. It reminds us that we can't control everything, and sometimes, no matter how hard we work or how smart we are, success or failure can be influenced by forces beyond our control. But it also encourages us to be more cautious and measured in our approach to risk. While we can't eliminate risk entirely, we can make decisions that minimize the chances of catastrophic loss. Housel offers practical advice in light of this understanding. The best way to manage risk is to give yourself room for error. This means not putting all your eggs in one basket, whether that's in your career, your investments, or your personal finances. Diversification, both in terms of your income sources and your investments, is crucial. You want to ensure that if one part of your financial plan fails, it doesn't bring everything else down with it. Having a buffer, a financial cushion, can help protect you from the inevitable risks and uncertainties that life will throw your way. Moreover, Housel reminds us that luck and risk don't just apply to individual success stories, they play a role in the broader financial markets as well. Economic booms and busts, stock market bubbles, and recessions are all influenced by factors that are often unpredictable. As investors, we can't control when these events will happen, but we can control how we prepare for them. The key is to build a financial strategy that can withstand uncertainty, rather than one that's dependent on everything going perfectly. Housel's exploration of luck and risk challenges the way we think about success, both in our own lives and in the financial world. By recognizing that luck often plays a bigger role than we'd like to admit, we can stay humble and avoid overconfidence in our own abilities. And by acknowledging the ever-present risk of failure, we can make decisions that protect us from the worst-case scenarios. This chapter ultimately serves as a reminder that success is never guaranteed, no matter how smart or hardworking you are. It's a combination of luck, risk, and decisions. And while we can't control luck, we can control how we manage risk. The goal, Housel suggests, isn't to eliminate risk, because that's impossible, but to prepare for it, to give ourselves the flexibility to bounce back when things don't go as planned. In the end, the lesson from this chapter is simple but profound. Approach success with humility and approach risk with caution. Recognizing the role that luck plays in financial outcomes helps us avoid the traps of overconfidence and hubris, while understanding risk encourages us to plan for the future with care and foresight. If we can learn to balance these two forces, luck and risk, we'll be much better equipped to navigate the unpredictable world of money. Chapter 3. Never Enough. In Chapter 3 of The Psychology of Money, Morgan Housel dives into one of the most dangerous and pervasive traps people fall into with money: the relentless pursuit of more. We've all heard the saying, "Money can't buy happiness," but in practice, many people live as if more money will eventually lead to a more fulfilling life. Housel warns us against this mindset and shows how the idea of never enough can be toxic, both financially and emotionally. Let's start with a simple thought experiment. Imagine you've just reached a financial goal you've been working toward for years. You've saved diligently, invested wisely, and now you're finally at a place where you have enough to live comfortably. But what happens next? Instead of feeling satisfied, many people immediately start looking at the next goal. They want a bigger house, a nicer car, a higher salary. They start comparing themselves to others who have more, and suddenly, what they have doesn't feel like enough anymore. Housel introduces this concept by telling the story of Rajat Gupta, a man who seemingly had it all. Gupta was born into poverty in India, but through sheer determination and hard work, he rose to become the head of McKinsey & Company, one of the most prestigious consulting firms in the world. He amassed a fortune, sat on the boards of major companies, and had the kind of career most people could only dream of. But for Gupta, it wasn't enough. Despite his success, he wanted more status, more money, more power. This drive led him to insider trading, and eventually he was caught and sent to prison. Gupta's story is a powerful illustration of the dangers of never feeling like you have enough. Here was a man who had more than most people could ever imagine, but it still wasn't enough for him. His desire for more led him down a path of unethical behavior, ultimately ruining his career and tarnishing his legacy. But this isn't just a problem for the ultra-wealthy. Housel points out that the never-enough mindset can affect anyone, regardless of their income level. Whether you're making $30,000 a year or $3 million, the feeling that you need more can lead to poor financial decisions. It's not about how much you have. It's about the mentality that having more will solve all your problems or bring you lasting happiness. And, as Housel makes clear, that's a dangerous illusion. The problem with always wanting more is that it creates a cycle of dissatisfaction. When you achieve one financial goal, you immediately set your sights on the next one. The goalposts keep moving, and you never get a chance to feel content or at peace with what you have. This constant striving can lead to burnout, stress, and ultimately, poor financial decisions. You might take on too much risk, over-leverage yourself, or make impulsive purchases because you're chasing an elusive sense of fulfillment. Housel explains that this mindset is often driven by comparison. We live in a world where it's easier than ever to see how other people are living. Social media allows us to peek into the lives of the wealthy and successful, and it's tempting to compare our own financial situation to theirs. You might feel perfectly content with your modest home and reliable car, but then you see a friend post about their luxurious vacation or their new sports car, and suddenly, what you have doesn't feel like enough. The comparison game is a trap because there will always be someone who has more than you. If you measure your success or happiness by how you stack up against others, you'll never feel satisfied. One of the most powerful ideas Housel presents in this chapter is the concept of enough. He argues that defining what enough means for you is one of the most important financial decisions you can make. Enough doesn't mean giving up ambition or settling for mediocrity. It means understanding what you truly need to live a fulfilling life. It's about recognizing when you've reached a point where more money, more possessions, or more status won't necessarily improve your happiness or well-being. Defining enough can be difficult because it requires self-reflection. You have to be honest with yourself about what truly matters to you. For some people, enough might mean having financial security, the freedom to spend time with loved ones, and the ability to pursue hobbies or passions. For others, it might mean living a simple, stress-free life without the pressure to constantly chase more. Whatever your definition of enough is, the important thing is that it's personal and not based on what others have or what society tells you should want. Housel illustrates this point with the story of the legendary hedge fund manager, Bernie Madoff. Madoff ran one of the most notorious Ponzi schemes in history, defrauding investors of billions of dollars. What's striking about Madoff's story is that he was already incredibly wealthy before he started his scheme. He had built a successful career and was earning a comfortable income, but it wasn't enough for him. His desire for more led him to commit one of the greatest financial crimes of all time, ultimately destroying his life and the lives of countless others. Madoff's story, like Gupta's, shows how the pursuit of more can lead even the most successful people astray. When you don't have a clear sense of what enough looks like, you're more likely to take unnecessary risks or make decisions that you'll regret later. Madoff had everything he needed, but because he wanted more, he lost everything. Housel also points out that the never enough mentality isn't just dangerous for individuals. It can have broader societal consequences. When people are constantly striving for more, it can lead to an unsustainable level of consumption and greed. This can create financial bubbles, where people take on excessive debt or invest in risky assets because they're chasing higher returns. Eventually, these bubbles burst, leading to financial crises that affect everyone. But how do we avoid falling into the trap of never enough? Housel suggests that it starts with a shift in mindset. Instead of focusing on what you don't have, focus on what you do have. Gratitude plays a big role in this. When you take the time to appreciate what you've already achieved or the resources you already possess, you're less likely to feel the need to chase after more. This doesn't mean you shouldn't set goals or strive for success. It just means that you should recognize when you've reached a point where you have enough to live a fulfilling life. Another way to avoid the never enough trap is to develop a sense of contentment. Contentment doesn't mean complacency. It means being satisfied with your current situation while still working toward your long-term goals. It's about finding balance between ambition and gratitude. Housel argues that true wealth isn't just about having a lot of money, it's about having the freedom to live life on your own terms without constantly feeling the need to accumulate more. There's also a practical side to this advice. By defining what enough means for you, you can make more informed financial decisions. When you know what you truly need, you're less likely to make impulsive purchases or take on excessive risk. You can focus on building a sustainable financial plan that aligns with your values and long-term goals, rather than getting caught up in the pursuit of more. This chapter offers a profound insight into the psychology behind our relationship with money. The idea of never enough is a trap that many people, regardless of their income level, can fall into. But by defining what enough looks like for you and practicing gratitude and contentment, you can avoid the constant cycle of dissatisfaction that comes with always wanting more. In the end, Housel reminds us that money is a tool. It's a means to an end, not the end itself. If we make the mistake of thinking that more money will solve all our problems or bring us lasting happiness, we'll never feel like we have enough. But if we can define what enough means for us personally, we can create a more fulfilling and sustainable financial life, free from the pressure to constantly chase after more. Chapter 4. Confounding Compounding. In Chapter 4 of The Psychology of Money, Morgan Housel introduces one of the most powerful and yet least understood forces in finance, compounding. At its core, compounding is simple. Money grows exponentially over time as returns are earned on both the original principal and the interest already accrued. However, while the mathematical concept is easy to grasp, the psychological impact of compounding is much harder for most people to appreciate. Housel argues that compounding is the foundation of wealth building, but its real power lies in its consistency over long periods of time, which is something many people struggle with. To explain compounding's influence, Housel offers the example of Warren Buffett, one of the richest men in the world. People often talk about Buffett's investing genius, pointing to his ability to pick winning stocks and make smart financial decisions. But what many overlook is the role time has played in his fortune. Buffett didn't amass his wealth overnight. He started investing at a young age and let compounding work its magic over decades. The secret to his vast fortune isn't just that he's a good investor, but that he's been a good investor for a very long time. Buffett's success illustrates the most important lesson about compounding. It takes time. The longer you let your money grow, the more powerful the effects of compounding become. In the early stages, the growth may seem slow or insignificant, but over time, the results are extraordinary. Housel compares compounding to planting a tree. At first, the tree grows slowly, and you may not notice much difference from year to year. But as the years pass, the tree grows stronger and taller, and eventually, it becomes a towering presence. Compounding works in much the same way. Small, consistent gains accumulate over time, and eventually, they lead to massive growth. The problem, Housel explains, is that most people are impatient. We live in a world of instant gratification, where we expect quick results and immediate rewards. Compounding, however, requires patience. It doesn't produce dramatic results in the short term, and this can make it difficult for people to stick with it. Many people abandon their investment strategies too early because they don't see the rapid gains they're hoping for. They get discouraged and move their money into riskier assets or chase after quick profits, failing to give compounding the time it needs to work. This impatience is one of the reasons why so many people struggle to build wealth. They underestimate the power of small, consistent gains over time, and they overestimate the potential of high-risk, high-reward investments. But as Housel points out, it's the slow and steady growth that ultimately leads to financial success. Warren Buffett didn't become one of the wealthiest people in the world by taking huge risks or making big bets. He did it by allowing compounding to work for him over decades. Housel gives another example to drive this point home. Imagine two investors, one who starts investing at age 25 and another who starts at age 35. Both invest the same amount of money and earn the same annual return. But because the first investor started 10 years earlier, they end up with significantly more money by the time they retire. The difference in their final wealth isn't because the first investor made smarter investments. It's simply because they had more time for compounding to work. Those extra 10 years make all the difference. One of the key takeaways from this chapter is that time is the most valuable asset you have when it comes to building wealth. The earlier you start investing, the more powerful the effects of compounding will be. Even if you don't have much money to invest at the beginning, starting early can make a huge difference in the long run. The key is to be patient, consistent, and disciplined. Over time, compounding will do the heavy lifting. Housel also points out that compounding isn't just about earning returns on your investments. It's also about avoiding mistakes that can disrupt the compounding process. One of the most common mistakes people make is trying to time the market, buying and selling based on short-term fluctuations. This strategy often leads to poor outcomes because it disrupts the steady growth that compounding relies on. When you jump in and out of the market, you're more likely to miss out on the gains that come from staying invested over the long term. Another mistake people make is focusing too much on short-term results. Housel explains that compounding is often counterintuitive because the biggest gains come late in the process. In the early years, the growth may seem slow or negligible, but as time goes on, the gains become more and more significant. This is why so many people underestimate the power of compounding. They expect to see dramatic results right away, but the real magic happens after many years of steady growth. Housel emphasizes the importance of having a long-term perspective when it comes to building wealth. Instead of chasing after quick profits or trying to get rich overnight, he advises focusing on the slow and steady gains that come from consistent investing. This requires discipline and patience, but it's the surest path to financial success. The longer you let your money grow, the more powerful the effects of compounding will be. He also notes that compounding isn't just about money. It applies to many areas of life. Whether it's building a career, improving your health, or learning a new skill, small, consistent efforts over time lead to exponential growth. The problem is that most people give up too early because they don't see immediate results. But if you stick with it and give yourself enough time, the results will be far greater than you could have imagined. In this chapter, Housel also touches on the role of humility in wealth building. Many people overestimate their ability to outsmart the market or make perfect investment decisions. They believe they can achieve better results by making bold moves or timing the market, but this often leads to costly mistakes. The real secret to building wealth, Housel argues, is accepting that you don't need to make extraordinary decisions. You just need to make good decisions consistently and let compounding do the rest. This idea is liberating in a way. It takes the pressure off of trying to be a financial genius or making perfect decisions every time. Instead, the focus should be on consistency and patience. You don't need to hit a home run with every investment. You just need to stay in the game long enough for compounding to work its magic. Housel's message in this chapter is clear. Compounding is the most powerful force in wealth building, but it requires time and patience. The longer you stay invested, the more dramatic the results will be. But the key is to avoid the temptations of short-term thinking and to trust in the process. Wealth doesn't come from taking big risks or making bold moves. It comes from letting compounding work for you over the long haul. He closes the chapter by reminding us that the real challenge of compounding isn't mathematical. It's psychological. It's easy to get discouraged when you don't see immediate results, and it's tempting to chase after quicker gains. But if you can resist these impulses and stay focused on the long term, compounding will reward you in ways that are far beyond what you might expect. Chapter 5. Getting Wealthy versus Staying Wealthy. In Chapter 5 of The Psychology of Money, Morgan Housel highlights an often overlooked but critical distinction in the world of personal finance: the difference between getting wealthy and staying wealthy. These two skills, while closely related, require very different mindsets and approaches. One of the biggest mistakes people make is assuming that the strategies that help them acquire wealth are the same ones that will help them keep it. But as Housel explains, maintaining wealth is as much about humility, caution, and avoiding unnecessary risks as it is about boldness and opportunity. To set the stage, Housel begins by reminding us of the many stories of people who achieved great financial success only to lose it all. The history of wealth is filled with examples of individuals who rose to the top quickly, only to fall just as fast. What's striking is that these individuals were often very smart and talented. After all, they managed to accumulate vast fortunes. But what they lacked was the ability to stay wealthy, which, as Housel emphasizes, requires a completely different skill set. The key difference between getting rich and staying rich, Housel argues, lies in mindset. To get rich, you often need to take risks, be optimistic, and seize opportunities when they arise. Getting rich usually involves some level of aggressiveness, whether it's starting a business, investing in risky assets, or taking bold career moves. In these cases, the willingness to bet on yourself and take chances can pay off handsomely. The road to wealth is often paved with calculated risks. However, staying wealthy is a different story. Once you've accumulated wealth, the focus shifts from taking risks to managing risks. The goal becomes protecting what you've built, rather than constantly trying to grow it at any cost. Staying wealthy is about defense, and that means being cautious, conservative, and, perhaps most importantly, humble. Housel tells the story of Jesse Livermore, one of the most famous stock traders of the early 20th century. Livermore made and lost several fortunes throughout his life, and while he was a brilliant trader, his downfall came from his inability to manage risk. He would make huge bets on the stock market, and while some of these bets made him incredibly wealthy, others wiped him out completely. Livermore's story is a cautionary tale of someone who was able to get rich multiple times, but couldn't stay rich because he never adopted the mindset of preservation over accumulation. In contrast, Housel points to people like Warren Buffett, whose financial philosophy is built around the idea of staying wealthy. Buffett is known for his cautious approach to investing and his emphasis on minimizing risk. While he has certainly taken bold steps to build his wealth, his real genius lies in his ability to maintain it over decades. Buffett's strategy isn't about taking excessive risks. It's about making sure he never loses too much. As Housel points out, you don't need to take massive risks to stay wealthy. In fact, the opposite is true. The key to staying wealthy is avoiding catastrophic losses. Housel introduces a critical concept here, the idea of survival. When it comes to staying wealthy, the most important thing is to survive. It might sound obvious, but in the world of finance, survival means more than just staying afloat. It means avoiding big mistakes that could wipe you out. It means building a financial strategy that is resilient and can withstand bad luck, market downturns, or unexpected events. This is where the difference between getting wealthy and staying wealthy becomes so apparent. To get rich, you often need to be willing to embrace risk. But to stay rich, you need to be incredibly risk-averse. It's not about making the biggest returns or taking the most daring bets. It's about ensuring that your wealth endures over time. Housel compares it to the difference between playing offense and defense in sports. When you're trying to get rich, you're on the offensive, trying to score as much as possible. But when you're trying to stay rich, you're playing defense, protecting what you've earned and avoiding unnecessary risks that could cost you the game. Housel emphasizes the importance of humility in staying wealthy. One of the reasons people lose their wealth is because they become overconfident. After achieving financial success, it's easy to believe that you're invincible or that you have a special ability to predict the future. This overconfidence can lead to reckless decisions, like taking on too much debt or making risky investments. But as Housel reminds us, the world of finance is unpredictable. No matter how smart or experienced you are, there are always factors beyond your control. Staying wealthy requires acknowledging that you don't know everything and that the future is uncertain. This humility is closely tied to the concept of margin of safety, which Housel stresses throughout the book. When you're trying to stay wealthy, it's crucial to build a buffer into your financial decisions. This means not overextending yourself, not taking on too much risk, and always having a safety net in place. For example, if you're investing in the stock market, a margin of safety might mean keeping a portion of your portfolio in safer, more stable assets like bonds or cash. This way, if the market crashes, you're not wiped out completely. The margin of safety allows you to survive bad luck or unexpected events without losing everything. Housel also talks about the psychological challenges of staying wealthy. One of the biggest threats to long-term financial success is the temptation to keep pushing for more. Once you've achieved wealth, it can be hard to shift your mindset from accumulation to preservation. The desire for more money, more success, or more recognition can lead to poor financial decisions. But Housel urges us to recognize when we've reached the point where we have enough. Knowing when to stop, when to protect what you've built rather than constantly chasing after more, is a crucial part of staying wealthy. This idea ties back to the concept of contentment, which Housel introduced in the previous chapter. When you're constantly striving for more, you're more likely to take on unnecessary risks. But if you can find contentment with what you have and focus on protecting it, you're far more likely to maintain your wealth over the long term. The goal isn't to stop being ambitious or to stop growing. It's to recognize that there's a balance between growth and preservation. It's about understanding when to be aggressive and when to be conservative. Housel sums it up perfectly when he says that wealth is what you don't see. Many people assume that being wealthy means living a lavish lifestyle, driving expensive cars, and buying big houses. But true wealth, Housel argues, is often invisible. It's the money you don't spend, the investments you hold on to, and the financial security you quietly build over time. Staying wealthy means avoiding the flashy displays of wealth that can lead to overspending or financial insecurity. It's about being smart, cautious, and patient with your money. In this chapter, Housel teaches us that staying wealthy is about survival, about playing the long game. It's not enough to get rich. You have to protect your wealth and ensure that it lasts. This requires a different mindset from the one that helped you accumulate wealth in the first place. While getting rich may involve taking risks and being aggressive, staying rich means being humble, cautious, and focused on preservation. It means avoiding the traps of overconfidence and greed, and instead, building a financial strategy that prioritizes long-term stability over short-term gains. Ultimately, the lesson of this chapter is that wealth is fragile. No matter how much you've accumulated, it can be lost if you don't manage it carefully. The key to staying wealthy isn't about making the biggest returns or taking the most risks. It's about surviving. It's about having the humility to recognize that you don't know everything and that the future is uncertain. It's about building a margin of safety into your financial decisions and understanding when you've reached enough. By adopting this mindset, you can ensure that your wealth lasts for the long haul.